There is that camp that believes that the earnings downgrades are not yet anywhere near where they need to be, which, you alluded to, that the market's trying to aggressively price in these reduced earnings. But what is your sense as to valuations in some of these US big corporates?
Yeah, so valuations are obviously they're much cheaper than where they were 3 months ago, 6 months ago, and definitely a year ago. The index is 22, 25 times. You can pick it up around 16 times broadly with most Western equity bourses. I mean, there's significant discounts to future earnings, and you're paying much lower prices for those future earnings because of the uncertainty. So obviously, if you're looking for equities and high yield market, credit markets, which is a risk in the bottom, above equities in the capital structure. But if you're looking at those areas on a 3-5 year, of course, it's just these are good historical levels. And then you have a look at the S&P 500 historically over the past 13 recessions, and it tends to correct between that 32 to 35%. Most of that's done already in the first half of the year, one of the worst starts since 1972. So that's a reasonable backdrop, but there is uncertainty, and it's the denominator. Where is the EPS in aggregate going to land? And if the price stays the same and the EPS gets revised lower, the multiple expands. There you go, but it's not the right expansion that you're looking for. So you're really trying to see where the numerator, the price of the index, where's the confidence going to come through? And I dare say it, between now and year end, there's going to be people pushing for the bear case and the bull case and keep pushing, and there'll be friction between it. But as an investor, where's it reasonable for those earnings going forward? And so we'll look at each week as the aggregate earnings come through. How does it look on the template? Where does US S&P 500 earnings? Does it land at $205, which I don't think it will? Does it land at 220? It's definitely not going to land at 225, $235 EPS for the S&P 500, but this is a pretty important period. So, and again, the guidance and the confidence of that. So equity valuations obviously are compelling given what happened in the first half of this year. But a lot of people that watch the market every day don't feel comfortable with that. But you should feel comfortable because the valuations are quite reasonable versus historical, long-run historical benchmarks. But and then where you're going to have the peak in the rate cycle as well. So that's why it's so important. Again, JP Morgan, Citi, Morgan Stanley, Wells Fargo, see how they come through on those reports. And then we've got the CPI number from the macro perspective on Wednesday night. And you'd like to see the headline number increase at a decreasing rate. That would be nice. If you can get a 8.6 to 8.8, you'll take that any day, and the core around 5.5. But on that short end, you've got to, the Fed, once it's pivoted in November, you've got to go as hard as you can, get it up there, and you're getting that flatness coming through, and the US 10-year just on the nominal coming just under, or 2.99, that accumulation, that duration position, that flatness is indicative now saying, well, we're going to get that slow down. Let's start pricing in that flatness to that potential inversion. Remember, recessionary indicators are inverted yield curves. We're not there yet. But the second half of this year these are real earnings coming through, just people aren't pricing them like they were a year ago.